This is Yvan here from Trading Composure. I create content to help you develop a trading psychology edge and to think about trading and the market beyond the obvious. Follow me on social media for daily trading psychology insights and perspectives. In today's video, I'm going to talk about the one thing that successful traders do that virtually guarantees that their success in trading, that raises their probability of success. You see, very often traders are bent on making trading a right or wrong endeavor. The moment they place their trade, they do it with an expectation of profit now on this trade, and that's the wrong mental approach to have. That's the wrong mentality to adopt in this endeavor, because the market doesn't work like that. If you've been trading for any amount of time, you've certainly noticed that sometimes you place a trade and immediately the market responds positively. Other times you place a trade and immediately the market responds negatively. Sometimes you place a trade, the market starts positive and later turns negative. Other times the market starts negative and later turns positive. I guess what I'm trying to say here is that in the short term, trade outcomes are randomly distributed. In the short term, trade outcomes are randomly distributed. In other words, you can't know for sure what the outcome of your next trade will be. There's an element of uncertainty in the market that no amount of analysis can fully dispel. And I mean, you don't have to take my words for it. Again, if you've been trading for any amount of time, you've certainly observed this short-term uncertainty. You've experienced it firsthand. Sometimes you get wins, sometimes you get losses. Sometimes you get streaks of wins and streaks of losses. And you don't know what the outcome of your next trade will be. You can't know what the future holds. You can't know what's going to happen next. You can make a probabilistic guess about what could happen. And you can get it right for sure. But you can't get it right with any kind of useful reliability. So what do successful traders do then? What's the one thing that they're absolutely positively obsessed about? No matter what they trade, no matter their style or time frame, no matter their preferred method of analysis. What is it? Risk control. That's what consistently profitable traders focus on and are quite frankly obsessed about. Risk control. This is what separates the professional money makers in the market from all the rest. And I would even further say intelligent risk control. Because risk control on its own doesn't guarantee much, especially if it's done in an arbitrary way, based on emotions alone rather than logic and strategy. So strategic, thoughtful risk control. This is key. Once again, there's an element of uncertainty in the market that no amount of analysis can fully dispel. And so what risk control does is that it helps you stay in the game. It gives you exposure to the market without blowing up. And this consistency of exposure eventually puts you in the right place at the right time. Exposure and risk control. This duo helps you generate long-term success in trading. Not predictions or fib extensions or indicators or price formations or whatnot. And I know I'm going against the grain here because that's not what the popular narrative is. The popular narrative is that technical analysis alone gives you an edge. That's why most traders spend hours upon hours deciphering charts. My stance is that on this is that the real edge in trading, on the retail end at least, is the consistency of exposure. It's the thoughtful risk management. It's the winning trading psychology. And lastly, if you want to add TA in there, technical analysis, sure, but that should be last on the list, in my opinion. To be clear, I'm not saying that technical analysis is useless. That's not what I'm saying at all. What I'm saying is that, I guess it's easier if it's easier to explain this using an analogy. I'm sure you've heard. I'm sure you know what a symbiotic relationship is. If you don't know, it's a relationship of mutual benefit or dependence, and you can observe that everywhere in nature. And a good example is the symbiotic relationship between Egyptian plover birds and crocodiles. After a heavy meal, let's say, crocodiles like to leave their mouths open, and Egyptian plover birds like to swing by and dislodge the pieces of flesh stuck in between their reptilian fangs. And this benefits both parties. One gets food, the other one gets free dental cleaning. But this is not without danger for the plover birds. Once in a while, one might get a little too cocky, a little too greedy, a little too sloppy, and all of a sudden, snap! It's over for the bird. The bird's now dessert for the crocodile. And well, as traders, we can learn a lot from that. I mean, we're also in a symbiotic relationship with the market. The market offers us tremendous opportunities on a moment-to-moment basis, really. And any one of these opportunities could potentially fulfill all of our wishes. Financial wishes, at least. And so it's very tempting to bet bigger. The market is always enticing us to do that, to up our position size, just like the plover bird is always getting tempted to go deeper into the crocodile's mouth to dislodge those bigger, juicier chunks of flesh. But be too greedy and sloppy and careless and cocky, and eventually that giant mouth will close on you. As traders, you gotta constantly watch your back. You can't rest on your laurels. You can't have high expectations for your trades. You gotta remain aware and vigilant and not so cocksure about things, I can't say this enough. Always, always, always watch your back. Cut your losses at your predetermined levels. Live to fight another battle. Live to fight another battle. This should be your most fundamental goal as a trader. Going back to the Egyptian plover bird analogy, if you don't get to eat today, that's okay. You'll get to eat tomorrow. And if it's not tomorrow, it'll be the day after. But constantly watch your back. That's what I mean by staying engaged, by having exposure to the market, by managing your risk and focusing on the opportunities that are worth it from a risk-reward point of view. In fact, in my own trading, that's what my clients pay me for. They don't pay me to predict the market. They pay me to give them exposure to the market, and while managing risk strategically, intelligently, professionally. All I'm doing is maximizing their upside while minimizing their downside. That's really all I'm doing. And I always make sure this is fully understood before I accept any money from anyone. I'm not an expert predictor. I'm an expert risk manager. I'm a professional risk manager. And I play the numbers game. Meaning I stay exposed, and on my trades I take small losses. I take null profits or losses, essentially break-even trades. I take small wins, and occasionally I take big wins, massive wins. And what this does is that it gives me this long-term expectancy, meaning I'm virtually guaranteed to win more than I lose in the long run. And so since I'm in this for the long run, for the long-term capital appreciation, big losses are a big no-no for me. Because, well, they derail my long-term performance. By the way, some people say that you should never risk more than 1% of your entire capital per trade. Some people say 0.5%, others say 2%, and up to even 5%. Personally, I think it all depends on your system and the kind of rewards you're shooting for, right? It depends on your personal preferences as well, and your risk tolerance. Obviously, you know best what you want out of the market. And that's the thing with risk management. There's both an objective and a subjective element to it. But what all consistently profitable traders agree on is that by keeping your risk small, what you consider small, because what you consider small might be different from what I consider small. But by keeping your risk small, relative to your account size, you'll get to place a lot of small bets with big potential payouts. It'll be easier for you to make rational decisions as well. It'll be easier for you to keep emotions and ego out of the way. But perhaps more importantly, by risking small, you'll get to stay in the game. And by staying in the game, by being exposed to the market, you'll raise your probability of success because you're constantly taking your chances. Okay, this trade didn't work. Next. Okay, this one didn't work either. Next. Oh, this one worked. Next. As you see, it's a journey. Trading is a journey. It really is. Keep this in mind. You'll never hear people say that they managed their risk, took small losses, and still their account went to zero. In fact, you'll hear the exact opposite. Once again, here are 4 trade outcomes you should aim for in your trading. Small losses, break even, small wins, big wins. By all means, eliminate big losses. Eliminate them from your process, eliminate them from your thoughts, eliminate them from your reality. I really want to help nail this into your subconscious. Be systematic with your risk control. Position size your trades in a way that you're not going to lose your shirt if something goes wrong, which can happen. When the market is about to hit your risk control threshold, don't hold on to what could be or should be. Live to fight another battle. Live to fight other battles. This is key, and I can't say it enough. View trading not as a get-rich-quick scheme, but as a slow path to success. Slow but practically guaranteed, if you get this risk control aspect of trading right. But most people don't. Here's a little cognitive reframing that I suggest you do from now on. This should help you manage your risk little better. Every time you place a trade or are thinking about placing a trade, imagine that you're flipping a coin. That's it. That's what the tip is. Imagine that you're flipping a coin. What this does is that when you're flipping a coin, well, there's no ego. There's no attachment to the outcome, right? You're not there begging that it's heads or tails, because you know that the outcome is out of your hands. It's up to chance. But when trading, we don't see it like that. Because we do analysis, we automatically think that the outcome must reflect what we saw when doing the analysis. And whenever the outcome doesn't reflect that, we feel disappointed, we feel angry, resentful, we feel robbed. That right there shows that there's a problem with our expectations. Our expectations are not aligned with the realities of the market. And so approaching your trade from the point of view of a coin flip sort of reframes your expectations so that you come to expect more noise, more randomness, more uncertainty from the market than you previously did. And so it forces you to manage your risk because question mark. You don't know the future. So do that. View your trades as a coin flip. No matter how confident you are in your analysis, it's sort of a little wink, a little nod to the uncertainty, to the uncertain nature of the market. It's you saying, hey there, uncertainty. I see you, and you will not catch me off guard. Now, I know it's hard putting on a trade knowing you could lose, but that's the nature of the game we're playing. Sometimes your mind will be screaming, this trade will be a sure loser. And next thing you know, it's a winner. But the opposite is also true. Sometimes your mind will be screaming, this trade will be a massively profitable trade. And then it ends up being a loser. So approaching your trade from the point of view of a coin flip is, well, again, it's a concrete nod to the luck and uncertainty that's inherent in the market. And it's an admission that the future is unknown. And in the face of such uncertainty, what's left for us to do is to be extremely disciplined with risk management without letting your fantasies determine your decisions. Risk management is so crucial to the endeavor of trading because it ensures survival under negative outcomes, which are inevitable. And it virtually guarantees maximum returns under favorable ones. Look, it doesn't matter how big or often you win if one loss or a series of consecutive losses have the power to wipe away everything, or worse, leave you shirtless. You gotta learn to protect what you have and keep more than what you give. Okay? So learn that. Learn to take controlled losses gracefully. And I can guarantee you, a few years down the line, you'll be a much better trader with a much bigger account. Like, subscribe, and share if you found this helpful.